In today's video, I want to dig into several questions that have been raised over the last few weeks, things that I think are really relevant, sort of a mailbag type format. And we're going to explore this format a little bit more on this channel as things move forward. So if you have questions, planning items, things you're working on, we'd love to hear from you and be a resource, maybe even feature your question on the channel in a video just like this one. So let's dig into it. I got three things for you. I've got the federal government shutdown, of course, which is on everybody's mind. And I've got two great questions that came in from different families. First one was a couple in their late 40s ask, which I think is a really interesting question. How do we compare to other federal employees like us? It's a nuanced concept that we have to be careful with, but I do want to take a look at it and give you some thoughts there. And the next question was, this came from a couple in their late 40s, early 50s. We've got about 65% of our money tied up in portfolio assets. So things tied to stocks and bonds. Is that normal? How should we be thinking about things? So just kind of take a look at all three of these questions. So first one's first, and I will just kind of reiterate, these are questions and things that we're answering on a day-to-day basis. So it goes beyond the projections for your first pension and how to keep FEHB and running the numbers on the investments. We're really digging into these real life situations and decisions that have to be made. They carry a lot of weight. Okay, so first thing, federal government shutdown. This is its fourth week, and the stalemate continues. It doesn't look like there's an immediate resolution that we can see within the next few days, right? So 4 weeks without a paycheck is a significant amount of time. The shutdown has not impacted the capital markets yet, but it has impacted federal families. So 4 weeks without a paycheck is a long time. We've got the beginning of the month coming up. So bills are coming due, mortgages, utility payments, car payments, whatever it might be. And you might be running low on cash flow just based on this extended period of time. So what kind of resources do you have? What sort of programs can you take advantage of in this situation to continue to bridge that gap? And we know back pay is still on the table, of course, which is a very good thing. With the law being passed several years ago that federal employees will be entitled to back pay. So let's look at it. If you have emergency savings, if you still have some balance in there, that's an obvious first choice. And that's why we set up emergency savings. But if you depleted that, it's running low, there's some other options that you might look at, including furlough loans from different credit unions. They'll offer federal employees these opportunities for short-term financing at favorable rates. Even regular banking institutions might have a different program that you could set up. So check your bank to see if there's any sort of furlough or short-term loan that you could take advantage of. Of course, there's TSP loans that you can apply for and get some funds in relatively short amount of time from your TSP account. And of course, these are all things that we'll want to pay back in a short amount of time when the back pay does hit. Then, of course, a great idea is to actually ask for deferment. So reach out to your mortgage company, reach out to your utility company, whatever institution it is that you owe the obligation to. See if there's any wiggle room, any flexibility that you might have for a deferment, so you can put off paying that bill for maybe even a month, right? Let's see what's available out there. And one thing that we want to be careful with, of course, taxable investment accounts are also accessible, but you want to be careful there for any unwanted tax implications. So if you've owned a taxable investment account for a while, you've seen some gains from the underlying investments, there could be some tax consequences there that you want to be mindful of before you just go liquidating positions, okay? If you need help kind of navigating anything specific, unique to your situation, love to be a resource. So like I mentioned, just please reach out. All right, so next question. And I think this is the one we need to be careful with. It's how do we compare to other federal employees like us? Because you've heard the saying, comparison is the thief of joy. And it's true, right? We don't want to run around and just comparing ourselves to neighbor Joe. I've got more in my TSP than he does, right? That's not the intent here. But I think there is some useful concepts that we can look at when it comes to benchmarking ourselves with our goals. Okay, so how are we stacking up against our goals and our ability to reach those goals and live the life that we want in the future? Everyone's situation is unique, right? So your skills, your experience, your salary levels, the way you've spent and saved over the years, those things are all unique. And so what we need to do is sit down and take a look at your goals and how your current progress is stacking up against those goals. So are you on track? But I will start out with just some useful benchmarks that you might be interested in. So things that a lot of federal employees that we see are currently doing: maxing out their TSP accounts, paying down their mortgages, helping their kids get through college education expenses. A lot of federal employees want their children to come out without a loan if possible. And a lot of federal employees, so many, are planning on working long enough to leverage their benefits, specifically FERS pension and federal employee health benefits. So that health insurance that you'll be able to carry into insurance. They want to make sure they work long enough to leverage those benefits. Those are very common things that federal employees that we see are doing. Now, a couple things fewer federal employees are doing, but they should be, okay? First one is contributing to other types of accounts outside of your employer-sponsored retirement plan or the TSP. So contributing to accounts outside of the TSP, as well as focusing on more so now, more federal employees are focusing on the Roth account than they had in the past, but incorporating tax diversification into the overall puzzle of retirement income planning. Okay. So more federal employees need to be doing that. Estate planning. This is a big hole in so many federal employee financial plans that we see. Okay. Estate planning is one of those things we love to drag our feet on. It really needs to be addressed. And I already mentioned taxes a little bit, but advanced tax planning, right? So tax optimization, which is looking for credits and deductions, as well as tax diversification, which is how we're structuring the different account types to kind of try to limit the tax drag in retirement. Some of the real questions that we need to be asking here, and I'm going to give you actually a pretty good benchmark. Are we saving enough? How do our pensions stack up? Can we quit working and live the way that we want to or the way that we're used to? Okay, so those are some things. I'm not going to get into the TSP benchmarks. You can find those things like you should have X amount of dollars when you're 45, when you're 50, when you're 55. I'm not going to touch on those. It's not the spirit of the video here today. But I do think, when it comes to federal employees, income replacement targets, this is pretty useful. I think for a lot of folks, it's somewhere between 50 to 60% of their pre-retirement income that they're trying to replace. I know we like to get into the details of retirement expenses a little bit more, which also makes sense. So, pre-retirement income versus pre-retirement expenses are two different things, but you can kind of take the ratio there and line the two things up. So pre-retirement expenses, you're probably going to spend 80 to 100% of those, which kind of matches up with that 50 to 60% spending of your pre-retirement income, if you stayed with me on the math there. So let me give you a simple example just to kind of drive a point home. And you can find these numbers like benchmarking Americans across, like when you're 40, you should have 5 times your salary. When you're 50, you should have 10. When you're 60, you should have 15. You can find those studies from JP Morgan, Bank of America, different research institutions. We'll put those together. But I want to give you a real simple example as a way to think about this that I think is more useful and more helpful. So for federal employees, we're really in a unique situation where you can replace a large amount of your pre-retirement income from two sources. Your first pension, if you're a career federal employee, 1% a year times your years of service. And then of course, Social Security. So you might be able to get somewhere above 50% when it comes to pre-retirement income being replaced from those two income sources. That's a great thing, okay? And if you're only trying to replace 60% and you already got 50, then you're really ahead of the game. But let's look at it this way. So a simple benchmark, if you have 10 times your annual income saved at retirement, you would be able to replace 50% of that salary from your savings, from your portfolio, okay, at a 5% distribution rate. So if you take 5% out a year, you'd be able to replace 50% of whatever that annual income was at retirement if you had 10 times that number saved. How do I get there? It's simple. Like, let's just look at the math here. So let's say you make $150,000 a year. That means 10 times that is 1.5 million. You take a 5% distribution off your portfolio of 1.5 million, and you've got $75,000 a year, which is 50% of that pre-retirement income. Now, we're not talking about taxes here, the implications. This is just a very simplified top line example, but it can give you an indication of how that translates. Okay, so if you have 5 times at 5%, you could replace 25% of your income. 10 times is obviously 50% of your income. And so the math works that way. So you can use those sort of simplified back of the napkin type math just to give you an idea of where you might stand in terms of your portfolio assets versus what your goals might be for retirement income. So I hope you find that helpful, if nothing else, from this section. Don't get me wrong, drilling down on expenses, super important. So you want to do that and get granular if you can. We want to get granular about all this stuff, but in these type of videos, we're talking about general things, high level stuff that you can use to start thinking through and putting together that plan that's going to become much more detailed and allow us to do those scenario analysis, that type of stuff. The last part got a little long, but so the last question is, we have 65% of our money tied up in portfolio assets. So things that are stock and bond oriented, right? Is that normal? I would say actually, if we're benchmarking this, I think that's below what most families in the US have. I think most families in the US, if you're excluding home equity from your primary residence, I think the majority of Americans have savings and then they have portfolio assets that is tied to the stock market. That's why there's ultimately so much focus on the stock market on a day-to-day basis, because the whole country is tied to this thing now. Our retirement, our futures are tied to it. So we need the markets to continue to be solid and stable and, a way to continue to create wealth for us over the long term. We find a lot less folks that have tangible assets, real property. I mean, there's some families that do have rental properties, but eventually kind of grow tired of managing them because that type of investment can be a lot more involved when it comes to managing them on a day-to-day basis. What's good about having money tied up in portfolio assets? Well, over the long term, historically speaking, there's no indication of future performance, but they've performed well. Portfolio assets have performed well, especially if you've invested properly within the equity markets. As I mentioned, they're easier to manage in some cases and account for than something like a rental property or tangible property. It can be easier to manage. The downside, of course, volatility, right? The stock market is incredibly volatile, and even bond markets can be pretty volatile. The market moves a lot, and it can be unforgiving if you're not quite sure what you're doing, if you're not disciplined, if you're not, really thinking through it in a smart kind of way. And sometimes it can be unforgiving even if you are. That's not to say that, that's the right move. It's just kind of the answer to the question is I think that probably the majority of Americans have more than 65% of their assets tied up in, equity-based investments, or I shouldn't say equity, capital market-based investments. Now, of course, there's no right or wrong answer to this. Real estate can be a great investment if you have the knowledge, the time, the expertise to go out and make those sort of investments and create diversification within your portfolio. That can be a wonderful thing as well, just to give you a little context. So that's kind of what I got for you here today. I wanted to give you context around those 3 questions. And so hope you found some value here. If you have, love if you give us a like and a subscribe. And like I mentioned, you have questions, things that you're working on, planning items, we'd love to hear about it. Be a resource, answer your questions. We'll see you next time, guys.